So in this lesson, we're going to be talking about deceleration and consolidation. That is actually something that happens on the chart at specific support and resistance level. Deceleration is when we want to be trading. When the market is decelerating, that is when we want to be executing positions either to the upside or to the downside. When we have deceleration at a specific support and resistance level, it pretty much tells us that it's about to reverse in the opposite direction. Specifically, when we have a very good reversal candlestick formation setup, like we learned in the previous lesson. Consolidation is when that deceleration gets extended over a longer period of time. That is when the market is moving sideways for a week or 2 weeks or even a month at a specific support and resistance level. We do not want to be trading when the market is consolidating. We need to see a breakout first above that consolidation. So we mainly want to be focusing on deceleration here, but again, I'm going to show you exactly what deceleration looks like and what consolidation looks like. So let's have a look. So it's important to note that we mainly want to be trading at specific support and resistance level, whether it's horizontal, trend line, or the 50 EMA, preferably maybe even all of them together. And then we want to see some kind of candlestick formation with deceleration. It means that the market was first accelerating to the upside and then decelerating. Okay, so that is what deceleration is. It first means that it's accelerating, it's exploding to the upside or to the downside. And then we needed to see it decelerate, slow down at a specific support level or resistance level. Consolidation is again when that deceleration continues for much longer than 5 days, a week, 2 weeks, maybe a month, maybe even a few months, depending on what time frame you're looking at. So let's have a look at the chart here. And right away on this daily chart, what we have, again, this is a range. This is a ranging market. We'll chat about that later. But when we look at this daily chart here, deceleration, again, we have a few support and resistance levels here. Let's start by looking at the ones at the top here. So they're mainly really good here in the recent times, but when we zoom out, let's just confirm to see whether they're actually decent support and resistance levels. And right away, you can see that the upper one was rejected a few times, once, twice, 3 times, 4, 5, 6, over 10 times, right? Over 10 rejections off of this upper level. Same thing on the lower one. We have 1, 2, 3, 4, 5, roughly 6, 7. It's more of an area. So the lower level is not as strong as the upper level, but it still has a few rejections. So we do have support and resistance. And right here, you can see that this run has been accelerating to the upside, specifically right here during this period in time. We had a lot of acceleration, and then you can see that when we actually look closer right here, that the market is actually slowing down. And what I mean by that is that it's actually the candlesticks themselves started being very large, and then they slowly started to get smaller and smaller and smaller as they were approaching this support and resistance level that we drew in. Okay, this is what deceleration is. It's when these candles start big and then they start slowing down and getting smaller and smaller and smaller as they hit some kind of support and resistance level, and then they finally churn around. Okay, so this is what deceleration actually looks like. And when we move forward here, now this is confirmation. Right here, when we finally get that bearish candle after the high test reversal, here we have deceleration at support and resistance. In this case, it's horizontal resistance with a high test reversal candlestick, and then this bearish confirmation to the downside. That means this level was just rejected, right? And then it fell down. Beautiful. So this is a beautiful example of deceleration and what it looks like at a specific support and resistance level with candlestick formation. Now, if we just jump back forward here, right here, however, you can see that price has come back to that same area, and now it started to move sideways, right? So a lot of the times deceleration eventually might turn into consolidation. And this is consolidation because you can see that it's now rejecting this level for quite some time, and it's not really getting anywhere. It's not going anywhere. It's not going up, and it's not going farther down. It's being squeezed kind of within the smaller triangle, right? So this is what consolidation actually looks like, right? So it might start off as beautiful deceleration, and you might even take a trade short there, But sometimes that deceleration might turn into consolidation, and this is what it would look like. It's just moving sideways for a week or 2 weeks or just an extended period of time, and it looks messy. Consolidation typically looks very messy on a chart, where deceleration looks very clean and simple, okay? So whenever we have a consolidating market, we want to make sure that the price action has first broken out of that consolidation before we actually take a trade in the opposite direction. Now, another example here of deceleration is right here. You can see that the market was accelerating to the upside and then started to get smaller and smaller and smaller. So started decelerating, the candle started to get smaller, and then finally we had this bearish high test reversal rejecting resistance, right? So that again is an example of deceleration. Same thing right here. Market was accelerating to the downside, and as it hit this support level, which was the previous lows over here, it started to slow down. We had this big bearish candle to the downside, and then it hit that support, and then all of a sudden we started to slow down. We had this beautiful low test reversal, and then the market churned around. So this is deceleration. Deceleration can last anywhere from a day to, I would say, 5 days, okay? A lot of times we might get like 3 candles. I don't really want to say days because that's only relevant to a daily time frame. We trade based on multi-time frame analysis, so we look at the monthly, the weekly, the daily, the 4-hour, the 1-hour, the 5-minute. So I'm going to refer to as candles, okay? So deceleration might last for 3 candles or 4 candles or 5 candles. But if it goes longer than that, then that is typically consolidation, because there's indecision in the market. The market does not know whether it's going to go up or down, right? There's indecision. So we mainly want to be focusing on deceleration, which is slowing down a little bit for a few candles at a time. Now, another example of that will be right here. And when we look at this daily chart again, we can notice that during this period in time, again, we had deceleration. We have some major support here. And as the market was accelerating to the downside, right away it started to slow down as it hit that support level, rejected it, and then it popped to the upside. This is again deceleration and a rejection of support. Same thing right here, right? Market started accelerating to the downside. As it hit that support level, the previous lows, it decelerated, right? Gave us this little low test reversal, and then boom, this massive bullish engulfing. Okay, this is again deceleration. This lasted about 3 candles, right? One big candle hit support, smaller candle, reversal candlestick, and then a big bullish engulfing, actually rejecting that level and exploding to the upside. So that is again a beautiful example of what deceleration looks like in the market. Now the last example here, this another major rejection, started off as deceleration, because you can see it started accelerating to the downside, and then the candles, as it approached support, started to get smaller and smaller. And then all of a sudden we started to get some reversal candlestick formations as well. We have this big, weird looking low test. It's kind of weird. I wouldn't really classify this as a proper low test reversal, but it is rejecting the support. And then this is kind of a tweezer bottom, where we have the wicks and this, we have the wicks kind of exploding to the downside and then rejecting, right? And then this bullish engulfing low test type of candle. Again, it's not a proper low test. It's not the best example of a low test reversal. But again, we do have these wicks that are testing this general area, and then we get this body that's rejecting this level. So this is kind of a tweezer bottom type of setup. You might even consider this a little bit of a bullish engulfing, because this body is quite big. But overall, this was deceleration. But now you can see it's just moving sideways, right? So we had this rejection off of this beautiful support level, which is really good. This is major support. And the market decelerated on that level for a few days. In this case, a few candles. This is a daily chart, so a few days. And then didn't go anywhere. It just did not go. It started moving sideways, and now we're over 5 days. 1, 2, 3, 4, 5. This is the 6th day now that we're moving sideways. And this looks more now like consolidation rather than deceleration. So a lot of times consolidation actually starts off as deceleration, like in this example. It hits a major support or resistance level, it slows down, but then it just doesn't go anywhere and it starts consolidating sideways until it finally breaks out either to the upside or to the downside. Now we're going to be talking much more in depth about deceleration and consolidation, how to avoid it, and when to know when it's the right time to actually trade in the opposite direction when the market is consolidating. That is when we start actually digging into the multi-time frame analysis lessons. At that point, we'll be looking at multiple time frames to actually give us a bias to the upside, bullish, or to the downside, bearish. So we'll be touching on this concept again in a lot more detail. For now, I just want to give you guys a bunch of examples so that you're able to identify what deceleration and consolidation actually looks like. Now I got a couple more here. We'll go through it really quickly. And again, looking at this monthly chart, we can see that this is a lot of consolidation. So this is a monthly chart. This monthly time frame has been consolidating. You can see that it has not gone anywhere. It's been staying in this kind of range, moving sideways for a few years, actually, since 2010 all the way up to 2013, and then finally broke out in 2014. So this is consolidation on the monthly time frame. But you can see that we have resistance, and you can also see that we have support. So then finally over here, right there, you can see that this is again decelerating on support level. Okay, what was once resistance right here became support. So the market started accelerating to the downside and then slowly started to decelerate. We had this lotus reversal, then we had this couple inside bars, another lotus reversal, this little doji, and then finally started to reverse in the opposite direction. To me, this is deceleration, it is not consolidation. You can see that slowing down and then starting to pop to the upside. And then eventually we had a nice little pop right there until it finally fell back down, okay? And rejected this level again one more time. So decelerated on it one more time, rejected it with this bullish engulfing, and then again popped to the upside. So that is again what deceleration looks like and what consolidation looks like here on this monthly chart. And the last, or a couple more examples I'll show you, is another example of deceleration here on the weekly time frame. So you can see again we have beautiful support. So whenever we're looking to place a position to the upside or to the downside, again, it's so important that we have some kind of support and resistance. That is always the first thing I look for. Is there support or is there resistance? Is the market decelerating? Do we have reversal candlestick formations, right? Now we're starting to combine all of the lessons together when we're building and making our analysis. So in this case, again, you can see here that the market was moving and accelerating to the downside, and as it approached the support level, started to slow down. Guess what? We have an inverted hammer reversal, right? So the market is decelerating. Then we had a lotus reversal, and then it exploded to the upside with this bullish engulfing, right? So that is, again, another example of what deceleration looks like in the market. And right here, this is just a random, you can see here, obviously on the weekly chart right there, price action is just moving sideways. That is, again, consolidation. That is not deceleration. It's just consolidation. And consolidation, again, is indecision in the market. Now, the last example I'll show you will be a little bit of a live example. So when we look at the chart here, right away we can see that the chart here has pulled back to this monthly 50 EMA, right? So we have a little bit of resistance, obviously the monthly 50 EMA. Do we have more resistance, right? So we always want to look for more confluence. And here's another really good confluence factor, and is this horizontal support and resistance level. So I'm not sure if I mentioned confluence factors before. There's positive confluence factors and negative confluence factors. Negative confluence factors are, again, horizontal levels, trend lines, 50 EMAs. It's when they are against you. It's when those support and resistance levels are against you. They're not in your favor. You're actually trading through them. That is a negative confluence factor. That is not good. A positive confluence factor is when they are actually aligning in your favor. So confluence factors are, again, support levels, trend lines, horizontal levels, 50 EMAs, and any other analysis that you have, like candlestick formations and so on. Those are confluence factors, and there's positive and negative. It just really depends whether they're in your favor or not. So in this case, we're building our analysis. So right away, we have this pullback in the market to the 50 EMA and this horizontal support and resistance level. Now, another thing that I look at is Fibonacci retracement. We're going to be talking a little bit more about that in the coming up lessons. But that is, again, another really important support and resistance level that I look at. It's a tool, it's a measurement tool. But we'll chat about that later. But for now, right here, we can already see that the market is accelerating. So it's not decelerating yet, it's accelerating, but we have this support or resistance area in this case. Was one support, because potentially will become resistance. We don't know yet, because right now the market is still accelerating. It did not reject this area yet. So we gotta wait for deceleration. We gotta make sure it's actually slowing down. Boom, inside bar. That's our first example that the market has actually just rejected this resistance. So we're slowing down, we're rejecting, the candle just got smaller. Another rejection. So right away, we're not breaking out, we're slowing down at this support and resistance level. At this point, I would already be looking for an entry short. Whether this is a swing trade or a day trade, I will be looking at the lower time frames. This is a monthly chart. So I will be doing my multi-time frame analysis process. Again, that's something you'll learn later. We're just building up into that multi-time frame analysis concept. But this is when I would start doing my multi-time frame analysis. But right here, we're already decelerating and potentially rejecting this level. At this point, I'm already looking for a trade short. And this is the final confirmation. Look at that beautiful high test reversal. This is, again, decelerating here for 4 days. And now we have this beautiful high test reversal. At this point, I would love to go short. So personally, I would be looking at the lower time frames and actually getting into this position. And you can see here that rejected it beautifully, and then it fell to the downside. So that is, again, what deceleration and consolidation actually looks like in the market. So we want to always look at major support and resistance level. We want to make sure that the market is decelerating. Typically, it starts off accelerating in whichever direction, bullish or bearish. We want to make sure that it's decelerating at those support and resistance levels. And decelerating via really good reversal candlestick formations, right? So within that deceleration, we want to see a reversal candlestick. Low test, high test, tweezer bottom, tweezer top, bearish engulfing, bullish engulfing, dojis, right? Inside bars, inverted hammers. They're all reversal candlestick formations. And when we get them at major support and resistance, that typically means that the market is slowing down and decelerating, okay? But when that continues for more than 5 days, 6 days, or more than 5 candles, right? Because if we're looking at different time frames, it will not necessarily be days, it could be months or weeks or 4-hour charts. So if it continues for a longer period of time where it starts to look messy and potentially there's indecision in the market, that is when we want to stay away and make sure that we first get a breakout and to the upside or whatnot. And again, we're going to be looking at this concept in much more detail when we actually get into the multi-time frame analysis lessons. That is, again, when we're going to look at deceleration and consolidation one more time with the concept of multi-time frame analysis. So that is it for this lesson, guys. I hope you enjoyed it, and I'll see you in the next one.